Frequently asked questions. Property held for sale versus property held for long-term investment. One of the commonly asked questions is, what are the criteria that the IRS and the tax court might look at to help determine whether property is being held for sale purposes or if property is being held for long-term investment? Keep in mind that property held for sale is excluded from Section 1031 tax deferral. However, property held for long-term investment qualifies for a 1031 exchange. So the key thing to remember in this scenario is that there is not a bright line test on this particular issue. The IRS can look at all of a taxpayer's facts and circumstances to try to determine, is the intent to hold for sale purposes or is the intent to hold for investment purposes. On the screen, you'll see some of the criteria that the IRS can look at to help determine whether property is being held for sale or investment purposes. And what I want to do is kind of go through some of these factors and expand on a number of them. They can certainly look at the purpose for which the property was initially acquired, how it was held during the ownership period of time, and certainly the purpose for which the property was being held at the time of the sale, at the time of the disposition. The extent to which improvements, if there were any, were made to a property. So if somebody buys a piece of land, large piece of land, and then they go ahead and subdivide it and cut in roads and run out utilities and water and sewer hookups, they look a whole lot more like they're subdividing to sell the property, to hold for sale purposes, versus holding for long-term investment. So that's another factor. Then we'll look at the frequency, the number and continuity of sales, the extent and nature of the transaction. And the next one I think is important, the ordinary course of business of the taxpayer. If you have a taxpayer that happens to be a dentist, and they get the majority of their income off of their dental practice, and they have historically, and in one tax year they happen to turn over 2 properties held for investment, that's a very different fact pattern historically and even in that year than maybe, let's say, a taxpayer who's a real estate broker or a developer who actively churns properties and is actively involved in that, and they get the majority of their income by turning over properties. So very different facts and circumstances, which would certainly help the IRS to determine the intent of the taxpayer. The next 2 items are fairly important, and honestly, some taxpayers create some issues for themselves because they maybe want to move forward with one of these. The first one is the extent of advertising, promotion, any active efforts used to obtain a buyer for the sale of the property. And this can include, obviously, listing the property with a real estate agent or broker. So if a taxpayer is able to make a good purchase opportunity and then immediately turns around and advertises that property as available for sale or listed with a real estate agent or broker, it really looks a lot more like that property is being held for sale purposes rather than with an intent to hold for long-term investment. And that could certainly be a factor. Investors that certainly would typically not qualify for a 1031 exchange would be investors that are doing fix and flip properties. They buy a property at a good value, put some quick improvements into it, and quickly flip it or turn it around for the short-term profit. That type of property would be excluded from 1031 tax deferral. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.